In mid-2022, near the height of the network news swirl on inflation fears, the Oak Harvest investment team put out a piece of research trying to dispel the notion that inflation would remain at 7 to 8% for very long. That history said the odds were high that inflation would peak and drop quickly, albeit not to 2%. I'm Chris Perras, Chief Investment Officer with Oak Harvest Financial Group, and this is our investment team's midweek release, where we examine a news item, headline, or story making the rounds from publicly available sources, and we ask, is it news or is it noise for your money? This week, we give our thoughts on the recent inflation data. Investors, this is a horribly frustrating topic for people like our investment team whose job and responsibility is to manage real money in the markets for our clients versus the academics, lawyers, and politicians who are making interest rate decisions at the Fed, trying to right their currently poor reputation. The Central Bank of the United States, our Federal Reserve, controls short-term interest rates, but their policies and public rhetoric have short and long-term effects on investors. In an effort to reverse their bad reputation stemming from their 2021 overly aggressive, easy monetary policies that caused a great deal of inflation in 2022, they still seem to continue to want to look mainly at only lagging components in the CPI, such as wages and shelter, versus the total basket or items that have led both up and down. The data, even the government data that lags, is irrefutable. The inflation impulse peaked last June and has been declining ever since. In fact, much as we forecasted and discussed in the second half of 2022, the CPI numbers are coming down in a very normal historical pattern and rate. Fast. We first discussed the historically symmetrical pattern of inflation rising and falling over prior cycles, citing some research from Alpine Macro. It's been almost 9 months since the CPI peaked around 8%. It's now probing approximately 5% year to year in March and only 0.1% month to month. Take a look at the updated chart of the symmetry in the CPI from Arbionne Research. As one can see, regardless of the headlines on CNBC, Bloomberg, Fox News, and Fed governor speak, the rate of change and level of the overall CPI is declining when and where it should. It mirrors similar inflation cycles, including the 70s and 80s. This should be positive for risk assets, including equities, should central bankers around the world pay attention to the leading, not lagging, indicators of inflation. Front page stories about inflation are news for your investments, for you and your family, because it does drive investor sentiment and Fed actions. With that said, these stories about inflation overall are improving and should be helpful, not hurtful to your portfolios. Are you trying to meet your needs or your greeds in retirement? Give us a call here at Oak Harvest and schedule an initial consultation with an Oak Harvest advisor. We'll sit down with you and your family and help you do the math to figure out if you'll be able to meet your retirement goals and needs. Call us here in Houston at 877-896-0040 and schedule an advisor consultation. We're here to help you on your financial journey into and through your retirement years. I'm Chris Perras, and from everyone here at Oak Harvest, have a blessed week.